we are officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. Today, we are talking about vertical integration, the number one thing that you want to look for when you are doing a rental property investment. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to affectionately call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And with us in the studio, moderating the chat, making sure that you got everything that you need is our phenomenal community manager. We call her MTM because she brings us the moments that matter and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
All right. And, if you are listening to us live on YouTube, you may or may not know that this also goes into podcast. And if you're listening to us on the podcast, you may or may not know that we do a live show every single week on Tuesdays and Thursdays at 12:30. And we got a thriving community and they all show up. So you want to show up and you do that by going to nyais.com, registering. Then you get to be part of what, GC?
The roll call, baby.
The roll call, baby. All right. We got Shannon Baker, touchdown maker, leading us off today in the house. We got Christopher Lee from Fernandina Beach. Good to have you, Christopher, back. Madison checking in with everybody. We got the leadoff hitter, their usual leadoff hitter, batting third today. Who's that, GC?
John Henning, baby.
John Henning, baby. Adding you to the spotlight here. We got Tony D in the house.
All right. Going to see him this weekend.
Anthony Dida, going to see you soon, man. I can't wait. Coming up from Jupiter. We got the better Greg number one from New Jersey.
Greg Stone,
of course. We got the second family of the Not Your Average Investor Show from Murrieta, California. Our regulars, GC, who are they?
Gary and Rosalind Riley, of course.
I love it. We got Nadeem Shah checking in. Good morning, good afternoon, JWB family. Hope everybody's doing well from the West Coast. I believe Nadeem is coming as well, right? We're going to see him this weekend?
Absolutely. Can't wait, Nadeem.
Can't wait. We got Michael Santorios in the house. Good morning, Michael. We got the ringmaster.
Drew Barnhill.
Drew Barnhill. Say good afternoon, peeps. We got the early bird in the house.
Ooh, Dean Curry.
Dean Curry from Columbus, Ohio, checking in. Gerard Wendling is back saying happy pancake day to UGC. We got the mountain man.
Bill Green coming in from the mountains of Colorado.
The mountains of Colorado. Good to have you back. Oh, the first family's in the house. We got the patriarch in the house. We got the matriarch, Ken and Carolyn Malene.
We salute you.
Salute you. We got Marie Rockoff back in the house from Scottsdale. Marie, good to have you back. We got Bill Shields checking in with his Buenas tardes, amigos. Buenas tardes, Bill Shields. And we got our favorite name to pronounce, Aaron O'Neill. Into the lights. Good stepping in. Chris Gonzaga from where, GC?
The illustrious Hudson Valley, of course.
The illustrious. We just realized that we got another fan from community member from the illustrious Hudson Valley. Our buddy Greg that we play spike ball with, visiting his mom in the illustrious Valley right now as we speak. Got a text message from him this morning. Shout out to you, Greg. I don't want to butcher your last name, so I'm not going to say it, but you're Greg. The other Greg. Third Greg number 3. We got Right Along Raj, my partner for my last Not Your Average Investor tour in the house, Raj Bondru. Good to see you. MVP is checking in from his phone today.
Doing MVP things.
Doing MVP. Lee Bishop in the house. Good to have you. Mark Norman is back. Hello, all. Good to have you back, Mark. And Marilyn Cotterman from Homosassa, Florida. You know what that's all about?
That's the home of the manatees, Pablo.
Home of the manatees. Believe that. Swimming with manatees. We got Leslie Wilson, our star community member from Denver. Leslie, really looking forward to seeing you in a little bit. And we got Walt Hart from Middleburg, Florida. Walt, good to see you in here. Walt's been here now a couple of times, right?
There we go. I know the name sounds familiar. He's making a presence.
It's a presence. I love the strong one syllable. Walt Hart got the assonance going. I like pronouncing it. It's all good. GC, let's get into the topic du jour today. That's topic of the day, in case you don't speak French.
There we go.
We're talking about vertical integration, right? This is a term that you and I really started evangelizing about a year and a half, 2 years ago, right? When we realized this idea that the more aligned everybody is in a situation, the better, right? Mm-hmm. This idea that if you have the same priorities as your investors, that's great. The idea that if your suppliers have the same priorities as you, even better. And the idea that if all of that is all under one team is kind of best case scenario for everybody. When you think about vertical integration, I know that you wanted to kind of like talk about what the definition is. How do you see it? What do you consider vertical integration?
Well, so vertical integration, if you boil it all down, it comes down to alignment of goals. And just, I think what we can all agree, I'm sure we have experience doing this, whether that is working with a team or being a client of some company or being an investor, when there is alignment of goals, it goes better. And it's not just that it goes better in terms of your experience, but it goes better in terms of the money that you make as well. And so investing in rental properties is no different. And when we talk about vertical integration, I think people think about it in terms of the amount of money that you can make. And that's all they think about. But the reality is, in rental property investing, the way that this thing works is you have to be in the game for a while to earn the best risk-adjusted return. And in rental property specifically, your experience matters so much because there's such a wide range of the experience. So if you want to be in this asset class, if you want to earn better risk-adjusted returns than your alternatives out there, you have to walk into an experience that is going to lend itself to your enjoyment for 5 years, 10 years, maybe even 15 or 20 years. And the reality is that it's hard to find investing in rental properties that you actually enjoy for that long. The only way to do it, in my opinion, is to work with a vertically integrated company. That's what allows you to stay in the game for 10 years. Otherwise, you're going to be just like every other rental property investor who is upset about the leaky toilet that they had to fix on the weekend, or the fact that they worked with a property manager, but they had a poor experience because the property manager didn't keep the home rented for very long. You're just simply not going to last enough in the game, and you're going to miss out on an otherwise much better overall return on investment, including the risks, a risk-adjusted return. You're going to miss out on it in rental property investing, and that's a shame.
Yeah. So what I'm hearing from you, GC, is this idea that you talk about often, right? It's all about, this is a long-term investment. This asset class gets better like a fine wine with age, right? And you said two things. The first thing that you said is, if you are vertically integrated, you make more money. And the other thing is, you're not going to make more money unless you can provide a good experience. Mm-hmm. So on this call, we're going to talk about both, right? We're going to talk about this idea of like, really? Do you really make more, really, bro? Do you make more money? Or is it just a market? And then we're also going to talk about what makes the experience better. Why does it work so well across all the different facets? Before we go there, I think there's a really great question from Leslie Wilson. She's saying, I was wondering if Greg got the idea to vertically integrate from someone else, or did he think of it on his own? Does he have a mentor in this space? If so, who might that be?
Great question, Leslie. I'll tell you, it was not our idea to be completely vertically integrated when we started JWB. You guys got to realize, when we started JWB, we were like everybody else who was getting into real estate. We didn't come from, a silver spoon. We didn't have resources that other people didn't have. We were 23 years old and we had no real estate experience. So when we started out this business, we fell in love with rental property investing. And we thought that we could build a business that would be done differently than most real estate investors. But quite honestly, it was built on the idea of us flipping houses in the beginning, because that's what most people think when they go into go into investing. After investing in 2006 and in 2007, we became aware of the different types of investments, meaning investing in rental properties as well as flipping houses. And we started to get connected with our friends over at Fortune Builders, and they became our first mentors. And they taught us that flipping houses really is a high-paying job, but that the way to build long-term wealth was through rental property investing. And so that got us on our journey of investing in rental properties while also building our flipping business. And then when we went through the Great Recession and we realized that we couldn't flip houses and sell them on the open market, we realized that we had to make a change. And that change became this vertically integrated approach to building rental property portfolios for everyday people out there, those who would not qualify as quote unquote rental property investors, real estate investors. They would never introduce themselves that way at a party. And so we said, well, geez, if we can create the same rental property investing experience for others, busy professionals, then that can be our niche. So along that path, we said, well, listen, if we're going to be really good at that, we have to be, everything has to be under one roof. And again, that was a learning lesson. It wasn't our ideal intention to actually build a property management company from the beginning, because nobody right off the bat, especially 10, 12, 14 years ago, was excited to jump into property management. And we weren't either. But for us, what we realized, if we were going to achieve our goal of creating a better experience for those to invest in rental properties, there was no other way other than us jumping in and having a complete alignment of goals with the property management company. And then, of course, as we jumped in, we began to love property management like we do now. But this has just been really we had great mentors in the beginning. I still do. Of course, Fortune Builders is a great partner to us. We're great friends with them. We've picked up other mentors along the way that have helped us. Big shout out to our friends over at REI Nation. Those guys are fantastic. We have many mutual clients, and we've continued to learn from each other along the way. And I call those guys really good friends as well. But, more than anything, this progression for us has been survival in the beginning, and then learning from some mistakes, learning from some big market swings, learning about how we were going to sort of combine what the market was giving us with what was going to make this the best experience for everybody long term. And that's where we are 17 years later.
I've heard you talk about it on the show and on our runs about this idea of you guys were basically like set to be just like all other turnkey property management companies and outsource the property management. But as your own portfolio grew and you realized that you didn't like the experience, you're like, how can we possibly grow giving this experience to others? So we got to figure this part out, right? Like like most things, people move away from pain faster than they move towards pleasure. And I love how you tell that story. I also wonder, GC, did you always call it vertical integration, or did somebody put you onto that term?
A very wise individual. He speaks many languages. He speaks French.
Oui. All right, we don't need to talk about how I came up with the term, and I'm brilliant. All right, GC, I want what people really want to talk about is money. Tell me what you mean by you make more money when you invest in a vertically integrated company.
Well, when you invest in a vertically integrated company in real estate, that's going to mean that their goals are aligned with yours. That's going to mean that they have their own money in the same place they are advising you to invest as well. And if you hitch your wagon to an investor or a company who already has their own money there in that market, the chances are that you are going to be able to earn better risk-adjusted returns than other real estate investors in that local market. And that's what we see. I mean, many people aren't aware, but investors who simply follow JWB and invest where we invest and where our clients invest earn more appreciation than average investors out there. And it's not the only example of kind of following a market leader and earning a better risk-adjusted return. Pablo, you and I were running this morning, and you were rattling off 2 or 3 examples of folks that invest where others invest. What were some of the ones you were talking about?
Yeah, to me, the first thing that I thought about was Publix, right? Like people believe that, when they see Publix putting up getting a lease somewhere or whatever, they're like, this is a neighborhood that's improving, right? So it becomes this like, and Publix is doing that because they've got really great data and they got some of the best kind of like in-depth research of the team, and they have built a really great company. So people see that and they just piggyback on it, and it almost becomes like a self-fulfilling prophecy. Leslie said the other one, right? Starbucks is another one that people see that like that. I think you see that in the stock market too, man. If you see Warren Buffett go buy a bunch of like pork futures, you're like, maybe I should get in on that, right? Like
exactly.
So I think once it's interesting how it's one part really good execution. And if you can prove that you can execute really well for a long time, you almost start to have this advantage of like self-fulfilling prophecy that comes in behind it, right?
Yeah. And I think it's a little bit different for us versus a Publix or a Starbucks. I'm not trying to insinuate that we're at that level of a market leader compared to a company like that. But there's different ways that you can shake it so that you can get to that final place of better risk adjusted returns. Like for us, we've been investing in the same neighborhoods that I advise all of you to buy rental properties since 2006. We own over 300 rental properties. We've sold over 3,000 rental properties, and they're right in those neighborhoods. So what we're able to do is to take this impact that we're having, whether that is improving neighborhoods, whether that is continuing to build new construction homes, whether that is taking the ugliest homes on the block or the ones that were not built out and turning those into the best looking homes on the block. You do that for 17 years and you do it in 4 neighborhoods, and you're going to get to a place where you have better returns on investments because you're centralizing your impact.
Listen, I can see how that happens when it comes to economies of scale, right? Like if you, just like you have, since you spend $7 million a month on construction costs, you get better pricing from people, right? Since you have all these like maintenance folks running around the neighborhood, there's less travel fees and other different things. But I find it hard to believe that you can really quantify that, because you can't then just go say, what would have been the price you would have paid me, right? Like if I didn't have economies of scale, right? Like nobody's quoting you the non-discount price that you normally get. So I imagine that's hard to track. What do you have that you can actually track to the idea that there's higher returns for vertical integration?
Yeah, well, so for years and years and years now, I've been telling people that I know you're going to earn better risk adjusted returns if you follow what JWB does, which is this is what we sell. We sell rental properties in the same neighborhoods over time. And I said, I know them because I track your returns on investment and they're better. But I really kind of didn't have a measurable way of actually validating that data. And then about a year ago, I was like, well, I can validate that. I can start to look at what market values have actually done for the average Jacksonville investor, and I can compare it to what the market values are and the appreciation rates are in our neighborhoods where we have our clients invest. And I can see if there's a difference. And so call it about a year ago, I really started to get, down and dirty with this data here. And what do you know? The results were what I was expecting. So, we've kind of talked about how, and many of you have heard me share that JWB clients have earned 79% more home price appreciation than the average Jacksonville investor since 2013. And so I thought today, and Pablo and I thought today would be a good idea to just kind of like walk you through how that data is actually collected so you can see what really has gone on in average Jacksonville versus our 4 neighborhoods.
All right, buddy, show us, man.
All right.
Throw it
cool.
up there.
I thought you might have a follow-up question, but no, there we
No,
go.
my follow-up question is prove it.
Prove it. All right, here we go. We're going to prove it. All right, guys. So can you see the screen there, Pops?
Yeah, I can see it, bud.
All right, my friend. So what we did is we took a look at all of the home prices in 2013, and we broke it down for all of Jacksonville. And all this information is coming off of the multiple listing service. Anybody can pull this information. So for all of Jacksonville, the median home sales price was $153,400 in 2013. And then, of course, we're looking at 2022. And the median home sales price was $340,000 at the time that I pulled this. We then went and broke down all of the 4 neighborhoods that JWB clients invest in. So you can see their median home sales prices back in 2013. Don't they look pretty attractive there, Pablo? Wouldn't you like to buy a property for around that, huh?
I would love to buy a property. And for those of you listening on the podcast, right, we're looking at 2013 Jacksonville median price point is $153,000. And then we're looking at the 4 neighborhoods in that JWB invests in called North Side, Arlington, South Side, and West Side. You see a median in North Side of close to 50, one in Arlington of close to 64, one in South Side of 85, and one in West Side of 58, with an average with a median of all 4 being 58.
There you go.
In 2013.
In 2013. Yeah. And that's the big thing that we're comparing here. All JWB neighborhoods versus the typical Jacksonville investor. And then you can see in 2022, of course, home prices have gone up significantly, right? The home prices in the different neighborhoods have gone up to, about 185,000 for the north side, all the way up to about 250,000 for the south side, and somewhere in between for Arlington and West Side. For all JWB neighborhoods, it went up from 2013's price of 58,000 to 2022's price of 230,000. So significant home price appreciation for JWB neighborhoods and significant appreciation for Jacksonville overall.
Yeah, which Jacksonville, for those of you listening on the podcast, went from 153 to 340.
So it really starts to get kind of interesting when you break down the average home price appreciation in the different segments here. So for Jacksonville overall, if you actually run a home price appreciation calculator, you'll see that on average, home prices went up 9.3% per year for all of Jacksonville. Now, Pablo, is that pretty good?
Pretty good.
Pretty good.
That's
What's
pretty
the average home price appreciation rate going back since 1982?
4.6%. So from 2013 to 2022, it's basically been twice the average home price appreciation than like the 20-year average.
Absolutely. Why did that happen?
I think 2012 was a super low, right? Like after 2008, stuff came to like the lowest that probably it's ever going to be. And then after that, it's been going up. Jacksonville has consistently been one of the 10 fastest growing cities in America. And like every list that you look at since about that period, right? Like living in Miami, I kept on seeing that and feeling like a chump that I'm not buying real estate up here until I finally moved here 4 years ago.
Yeah. I mean, a lot of people feel that way. If you boil it down into like today's terms, we're talking a lot about supply and demand, right? And from the demand side, we're talking about affordability. Well, home prices were really low then. We were coming out of the Great Recession. So affordability was really high. And then supply was incredibly low, which is the way we have it now. But months of inventory were lower than 6. And so you had the setup for higher than normal home price appreciation, right? And again, from the supply side, one of the reasons why I'm confident that this is not going to be a crash like 2008 is because we still have 3 months of inventory right now. The lower you get below 6, the lower the supply and the more stability to prices. And actually, it would indicate short-term price increases more than the national average, or excuse me, more than the historical average.
Yep.
So that's where we stood. For if you just bought any property in Jacksonville, like an average investor, you would have experienced 9.3% home price appreciation year over year over year. It was a good time to buy in Jacksonville. But the theory that I have always had is that if you're investing with a vertically integrated provider, they should beat the market. They should beat the real estate market. No matter what Jacksonville's home price appreciation rate is, we should be able to beat this for our clients. That's why one of the reasons you should invest with us. And look at what we were able to do. In the north side, for example, the north side experienced about 15.7% annualized home price appreciation, one of our core neighborhoods. Arlington experienced 16% annualized home price appreciation. Southside experienced 12.7% annualized home price appreciation, and the West Side experienced 16.6%. If you combine all of those, for all 4 of those JWB neighborhoods, we experienced 16.5% annualized home price appreciation. And if you compare that to what the average investor experienced, that 9.3%, we were able to show 79% more home price appreciation simply by investing with JWB in our neighborhoods.
Yeah, man, this is like just looking at the numbers is significant. When you add the context of understanding that when you look at the returns as a whole and you break it up into a pie, the home price appreciation part is like the Pac-Man and everything else is just the mouth of the Pac-Man. To exaggerate that piece by 80%, 40%, 70%, 70%, like that to me seems like the story that's not being told here. I think the other really, like the idea that this is why we say it's the number one thing, right? Like, because you are supercharging the number one side of the best part of this investment for your wealth, for your like optionality to like take equity out and do other things with it, right? Like these like infinite returns kind of concepts. To me, that's super, super attractive. Something else that just looking at this data stands out to me is, as a Jacksonville resident, I know that North Side, Arlington, South Side, and West Side, that South Side neighborhood is actually a pretty good neighborhood, right? Like that South Side neighborhood, if you were to tell me where I want to live out of those neighborhoods, that South Side neighborhood is one that I would want to live, and it has the highest median price that it's appreciated to, and yet it's the one that relative to the rest of it appreciated the least. Why do you think that is, GC?
Well, you've got to look beyond amenities. You got to look beyond best school ratings, right? You've got to look for neighborhoods that have low prices, high rents, surrounded by jobs, right? And nowhere along the line does it say they have to be located near a great shopping center, or they have to be located near in the best school district. To your point there, Southside, if you looked at the average school ratings, has the best average school ratings out of Northside, Arlington, and Westside. And now, I mean, I guess we're kind of like talking down about 12.7% returns. But what this really highlights is that it's not about those things, that those commonly held beliefs that people have when it comes to rental property investing, right? It's about investing in a neighborhood with those characteristics that I just talked about. And it's about investing with a vertically integrated provider who is incentivized to make sure that their own money grows in those neighborhoods as well, right? You think about some of the impact that we have had in these neighborhoods. Like, for example, on the Arlington neighborhood, it's not just the single family homes that we continue to build and renovate and our clients continue to purchase and we continue to manage, right? We're investing in a shopping center right outside, on the outside of Arlington and between Arlington and downtown. That's going to have a tremendous impact in the Arlington neighborhood, and we continue to have impacts in all four of these neighborhoods. So you got to kind of flip it on its head a little bit. It's not what you probably read in a book, or you talk to a friend about how to win in rental property investing. It's working with a vertically integrated provider who makes more money when you make more money, who has an impact in those specific neighborhoods, and is able to sort of centralize that impact by being very defined in a small area.
Yeah. I mean, it's that combination of economies of scale and alignment of incentives in order to like really drive max return, right? Leslie's got a question. She's asking, is a lot of this dramatic home price appreciation because JWB redevelops the lot, removing mobile homes and replacing it with detached single family?
Yeah, that's a lot of it too. I mean, you look in some of these areas, I'm wondering if I should kind of pull up the map here. Pablo, do you want to just kind
of pull up the map? Why don't you unshare while I pull up the map? You can keep talking.
There we go. So, you look in these neighborhoods and it is the same thing over and over and over again. I mean, there are hundreds of properties within a 1 mile radius of the property you would be purchasing. And it's because we do the same thing over and over again. And which properties are we purchasing? Are we purchasing the best looking homes on the block and then, renovating those and building new homes on those? No, we're taking the worst ones on the block. As you start to look at this map, Pops, thanks for bringing it up, buddy. I mean, let's look at Arlington. Probably the best example is the Oakwood Villas area. Do you know, man, I'm kind of putting you on the spot. You know where Oakwood Villas is?
I don't know where Oakwood, no, but here's Arlington.
Yeah, go to that, like, you can see where it's highly concentrated there, right below Arlington Expressway there.
Right here?
Yeah, right there. Yeah, zoom in there just so people can see how many homes we have renovated or built in that area. I mean, that right there is the birthplace of build to rent, by the way. This is the first place that we started to build to rent, build new construction homes and rent them out. So, we are taking, in this area, we took homes that are the worst looking homes and we renovated those. We took lots that were undeveloped. We built new construction homes onto those. And then there were a lot of mobile homes. There still are some mobile homes in that area right there. And a lot of times we'll buy the lot that had a mobile home on it, and there will be a brand new 3-bedroom, 2-bath, 1,200 square foot home there. So you start doing that over and over and over again, and it improves the neighborhood significantly and improves market values.
Awesome, man. I saw in the chat, where is the differentiation between like north side, west side, and south side, right? Like it's basically just like north side is this closer here north of downtown. West side is this closer here, like west of the naval station. South side is kind of this corridor here. And then here's Arlington.
Yep, exactly. North side, we would basically call anything north of I-10. We'll call the north side south. And so I-10 is, if you want to kind of, yeah.
Here's I-10 over here.
Yeah. So anything north of that is the north side. South of that would be the west side. South of that and west of the river there is the west side. And then the south side would be east of the river and sort of, I guess south of Oakwood Villas, like we were just talking about. Oakwood Villas would be considered Arlington.
Got it. Okay, cool. Let me unshare this, go back to regular conversation. There's one more question before we get into it. So love that you showed this, GC. I love the data. I love like showing people. I think that this is really, really informative. Kelly Berenbaum has a question. Welcome back, Kelly. Haven't seen you in a minute. What's going on in Springfield? Is that one of your neighborhoods?
We do have a significant presence in Springfield, but it's not on the turnkey rental side just yet. The returns aren't there. They're not good enough to meet our standards for you all as turnkey rental property investors. But we have made a significant investment there. We own about 40 lots in Springfield. And this is one of those examples where we will invest in those lots. I mean, we bought those, goodness, maybe 8 years ago, maybe 10 years ago, because we expected that this would blossom for our community. And then we'll be building those out over the coming years, and we'll be selling those to retail investors, meaning those who are going to buy those homes and live in those homes. Just can't make the numbers work for turnkey, for you all, for your risk adjusted returns. And that's the only reason why we wouldn't do it for a turnkey investment for you.
Cool. Awesome, man. So that's the data, right? Like that is the whole, this is why it matters, right? You make more as you stay in this investment. You make more than other properties around you when you're dealing with a vertically integrated provider, aligning of incentives, right? Let's talk about what the experience side, the other part, right? Like, because you're only going to stay in the game. I think Leslie was in the chat saying she can't wait to exit her Detroit property, right? Like you're only gonna stay in the game if you have this good experience. So, when I think of this asset class, I think of kind of like the different stages of what the experience. And when I tell my friends, like, what does JWB do? And I'm like, well, they basically sell you a cash flowing property. Like if it's a bond, because they perform everything, like they control everything from like land all the way to like your portfolio management. So let's talk about that, right? I guess the first stage in the process is land acquisition. What is the typical experience one thinks of when it comes to rental property, when it comes to like acquiring a lot? What's a typical turnkey experience and what's a vertically integrated experience there?
Yeah. So let's talk about like the old way, the antiquated way of buying rental properties, right? That involved so many different players in the game with so many different agendas who made money so many different ways. Typically you would work with a real estate agent. Well, that real estate agent is going to make money on selling you the property. They're going to make a commission on selling you that property. So they're going to be incentivized to give you the best numbers, right? If the numbers are the best and you buy that property, they make a commission at that point. Whatever happens later on, they're not in the game. It's not their responsibility, right? And hopefully you work with a great one who has done this, but at the end of the day, they don't make any more money or any less money if it turns out the way that you expect later on. And that's a problem. You want to be working with people who make more money when you make more money. And then, you work with a real estate agent. They say you buy the property. Then you go and if you want to buy a property that is going to be an opportunity for you to earn better returns, you're probably going to buy one that is distressed. Your real estate agent certainly doesn't handle construction. So now you got to find a contractor. And, who wants to manage a construction project? Well, you might not want to do it, but you signed yourself up for it. I'm sure everybody here who has done any sort of construction project realizes that it's very easy to go twice over budget and twice over timeline. It happens more times than I'd certainly like to admit. And we do this hundreds of times a year. So, that's not what you want to do when you're going in, especially into your first rental property investment. You don't want to be footing the bill. And of course, your contractor doesn't make any more money or any less money, depending on how your investment turns out. You can go on down the line, financing, making sure that you have the right loan, right? If you're going at it alone, or if you're going at it just by a referral from somebody like a real estate agent, you're just setting yourself up for a poor experience. Finally, you get to the end of that really long experience and you go and find a property manager you probably didn't think about in the beginning. And you probably think property managers are just like, they're a dime a dozen. You can find anyone by going to Google. And then what happens is you get to the final stage when you've endured a lot to buy this property and renovate it, and you go to get the home rented. Well, that property manager was not on the same page with your real estate agent, your realtor in the beginning. So whatever rent number you were thinking in the beginning, many times changes by the time it gets to that property manager 3, 6, 9 months down the line. And, unfortunately, if you're off $25 or $50 a month in rent, might sound like a little bit, but that can absolutely be the difference between positive cash flow and negative cash flow for you on your rental property. And so you get to the end of the road and you just realize that none of the numbers you thought in the beginning actually pan out. And the problem is you don't have anybody to go to be accountable. That's the way people have bought rental properties for a long time.
Yeah,
And
that's the old game, how you say it, right? Like that is 95% of people that you talk to are just like, nah, rental properties, I'm out. I did that one time. Somewhere they tripped somewhere along one of those decision points because they were kind of like handling one or many of those things themselves, right?
Mm-hmm. Absolutely.
Yeah, man. So then what is turnkey? Tell me how you would define turnkey that's different than that. And then we'll talk about how that's different than vertically integrated.
Yeah. When I started to invest in 2006, nobody said the word turnkey. It was not a thing. There was no definition for it. We spent so long just educating the market of what we were trying to create. And there was really only us and maybe two other turnkey providers out there. And, at that point, turnkey really meant the same thing as vertically integrated. It meant that all of your goals were aligned. And so for years and years and years, I talked about us being a turnkey provider because that has been my definition of what turnkey is, but geez, especially in the last, call it 5 years, especially in the last few years, as investing in single family rental properties became the darling. I mean, it's even the darling of Wall Street right now, right? You have tens of billions of dollars that are rushing into the space. So anytime something like that happens, everywhere along the line, people start paying attention. And you had so many people, so many companies, so many realtors come into this quote unquote turnkey space. And they diluted the definition. The definition of turnkey now is there really is no definition. You have a lot of real estate agents out there who claim that they sell turnkey properties, and all they really do is look up a property on the MLS, put a property evaluation together, email out to their people on their email list, get somebody who says, yes, I want to buy that property. Then that real estate agent goes and tries to put that property under contract. Like, see, they don't even own it yet. And then they try to match the deal up all the way. They refer people to another contractor who is not under one roof, not under their roof. They refer people to another property manager who is not under one roof. But that is turnkey to them. And so it was really great, 2 years ago, whenever you and I were chatting about this, I think it just came from like a place of pain for me. Cause I'm like, man, everybody is taking the good name of turnkey and they're using it. And I need another way to communicate the difference here. And that's where we really started to talk about vertical integration, because vertical integration is different. Vertical integration does have alignment of goals, whereas turnkey right now would be basically, a system of referrals for you. Somebody helps you get the property, but there's a system of referrals, which is not the same thing as under one roof.
Yeah. So I guess when I think of it, right, when I think of turnkey, I think somebody is giving me this house with a team in place, right? Like I'm not necessarily looking for a contractor and property manager and property. Somebody's coming to me and they're saying, hey, the work is going to be done by this person. Here's the property. Work is going to be done by this person. And year one, it's going to be managed by this person. So they're bringing you that deal, at least with those players in, that starts to be, to become turnkey, right?
Mm-hmm.
Yeah. So that makes sense. And it's one of those things like all vertically integrated is turnkey, but not all turnkey is vertically integrated.
Exactly.
Right. Cool. Got it. So then when do you have like a switch of 0 to 1 from like turnkey to actually vertically integrated? What is that?
Well, acquisitions, construction, property management all need to be under one roof. The same person who is selling you the property or the same company has to be the same company collecting the rent at the end of the day. That would be just a simple definition of vertical integration.
Yeah. The person that sells you the property is the person that collects the rents. Love that. Love that. So that is baseline vertical integration. And that, again, now we're talking about the idea that it's one phone number to call, right? Like that starts to, when we started this call, it was vertical integration. Vertical integration is essentially aligning priorities, right? So now you're talking about, hey, something is wrong, right? And the property manager isn't saying, oh, that's because the builder didn't build this thing out to like what the contract was, or I can't really get this rent, you bought it wrong, right? So like now that phone number, that problem all goes to one person, and people can't hide behind that, right? That is the basis of vertical integration.
100%. You'll know it when you see it. If you have one phone number to call for the life of your investment, that's vertical integration.
Got it. Cool. And then even within vertical integration, right, you see there is kind of multiple levels of it, right? Like the 0 to 1 is the one phone number. But one of the big reasons, quite frankly, that we started saying we need to talk about vertical integration, or at least for me, I'm like, we got to talk about vertical integration, because I don't think anybody can compete with your level of vertical integration. And you guys, your team, has taken this idea of one phone number and really started to expanding it beyond. You want to talk a little bit about that?
Yeah. So I think there are some companies out there that are vertically integrated, and, and it's a relative few in this space, but there are some. But then I think, once you reach that level of vertical integration, there are things that you can do to maximize the impact of vertical integration. And there are things that you can do that sort of dilute the impact of vertical integration. And, of course, when you maximize the impact, that's going to have a better experience for the investor, and that's going to have better risk-adjusted returns. When you think about our approach here in Jacksonville, the fact that we are committed to one market, that's an effort to maximize the effects of vertical integration, right? And those, for our friends who are going to be joining us this Saturday on the tour, super excited about it. You're going to get to see this in reality, right? You're going to be able to go on. We're going to go on this downtown walking tour, right? The fact that JWB is so committed to Jacksonville, one of the ways that we have shown this is by putting our money where our mouth is. And we've acquired about 20 blocks on the north bank of downtown Jacksonville. I mean, 20 blocks. You guys are going to get to go and walk inside some of these buildings here. I just want to, I feel like you say we acquired 20 blocks, like if anything, 20 blocks, not 20 properties, 20 city blocks of downtown Jacksonville, of like an urban center of a, secondary city, I think is nuts. It's 12% of the north bank of downtown Jacksonville.
Yeah.
Right. So, but why does this benefit you? Why is this such a strong move for a vertically integrated provider that pays off for clients? It's because it has been proven when downtowns revitalize, the properties, the single family rental properties that are owned right around downtown thrive. We have seen that in Nashville. We have seen that in Denver. We have seen that in Miami, right? This is one of the reasons why JWB has made such a big investment. And so for those vertically integrated providers that focus on one market, it's a huge opportunity for you as an investor to ride their coattails. So for so long, I would get this question from investors. Oh, geez, JWB, I love what you're about. I just wish you were in like 5 markets. I wish that you were in 10 markets. And I would say, I just don't think you get it. I just don't think you get it, because you should really be going and talking to those other providers in 5 markets or in 10 markets and say, hey, can you make some significant investments in downtown Jacksonville, in your downtown? Yeah. Can you work with community leaders to make sure that variance codes are working so that we can increase our overall market values or whatnot? What can you do to work with social and community and do all of these things?
Protect landlord rights, right?
Protect landlord rights.
Major risk mitigation.
Can you try to build a shipping container apartment so that you see if you can drop building costs so that all of your investors could do? Could you focus on one market and try these things? Because it would really, really help me out as an investor. That's the question I want people to ask others. Nobody asks that question. I used to get it on the other side. And that's not to say that others can't be successful going to other markets and whatnot. But what I'm saying is By focusing on one market, the effects of vertical integration are maximized. You would need a tremendous amount of resources to have the same type of impact across 2 markets or 3 markets or 5 markets. And I don't see any, even the vertically integrated providers out there attempting to have those type of impacts, but we know what it can do for clients. I mean, 79% more home price appreciation in our neighborhoods. And that was before our investments in downtown Jacksonville.
Yeah.
So I'm trying to beat that for you all.
Yeah. Listen, man, what I take away from it, right? And I haven't answered Bill Green's question from early on, because he asked, what other areas outside of Jax might JWB be seeking to expand in the near future anywhere out of Florida? The answer is none, right? Like there is no expansion out of it. And it's the picture that you just described to me is like maximizing aligning with incentives, right? If you're selling someone a deal that isn't just turnkey, that's vertically integrated, then, it's one thing if a company is selling you a deal with a house that's going to be cash flowing and they have a property management company, but is that property management company going to be there for the 30 years of that home, right? Like, and be there beyond that when you want to hand this thing off to your kids and stuff like that. To me, this idea of that makes vertical integration inside of this asset class tick is a very long-term mindset, right? And the fact that, it's one thing to make an urban core and make a play at raising median incomes. To me, is the outside reaches of upper echelons of like what a vertically integrated company can do. But, even well before that is the stuff that we're talking about. It's this idea of just like setting the neighborhoods up to succeed, making long-term decisions that is going to raise median incomes, that then allow for higher rents, that allow for the appreciation in that neighborhood to continue to rise, right? And like doing those types of things, the tenant right stuff, all the, like being within local neighborhoods and having a good name in the community so that when people see your asset, they're like, oh, I want to rent there because I know that they treat people well, right? Like all these things are very soft, hard to measure things that you don't see unless you can take this like wide angle view and do what you just did, GC, and like look at it over 10 years and see that this thing beats everything else by 70%.
Absolutely. I mean, I think these are like these things that we're talking about, the investment in downtown Jacksonville, the other things that we do in the community, those are not the reasons to invest with JWB, right? The reasons to invest with JWB is because this is a better risk-adjusted return than your other alternatives out there. This is a better experience than other experiences you would have investing in rental property specifically, right? And then you hold on for the long haul, and this thing works, even if you don't have better than average home price appreciation. You get 4.5% on average home price appreciation over 10 or 20 years, each and every single year, you're going to do better than your other alternatives. So that's the reason to invest with JWB. This represents some upside. Like this represents, call it's opportunistic built in with it. That's what the vertical integration that JWB can provide allows you to do from a returns perspective.
Yeah, makes sense, man. I like to me, it all made a lot of sense. This idea of just like long-term view. We started just defining it as vertical integration is one number to call. And then the more integrated you are, the more that you are affecting things outside of just the property line. And it's kind of like concentric circles. And I think you're at this like crescendo of what you're doing right now with the placemaking that you're doing downtown. And again, go back to the numbers, right? JW, as a result, what you have proven is that before, when you just first started with the ripples, you've already been able to deliver. What's the median appreciation above the regular market?
Well, it's 79% more home price appreciation than the average Jacksonville investor since 2013.
So 79% appreciation, more than the average Jacksonville investor. This is just the beginning of the ripples. Now these ripples are really starting to reach out like beyond into a lake. I think that the upside that's there with the vertical integration piece continues to happen. And, you're not going to find a lot of companies that are working at that scale, but if you're investing in another market, this is the stuff that you want to ask about. Like, how are you starting these ripples? How are you starting to like test this idea of going beyond just the one thing that you do and what else works and what other kind of like compounding effects can you bring in? I think that's the big takeaway for anybody that's listening right now, that's truly looking for a passive investment experience that's going to over deliver, right? I would love to, do you have any kind of like caveats to that? I'd love to get into some questions to wrap it up here.
Well, let's go into questions, man.
All right, let's go on to questions, man. All right. Michael Santorius asks, Greg, congratulations on the award between JWB and the Jacksonville Housing Authority. My question is, has JWB ever considered doing a real estate syndication for residential or commercial properties?
Great question, Michael. So, we have done various investment vehicles over our timeline. We did a Reg D 506B offering back in 2010 through 2012. That's just a type of offering there. It's not exactly a syndication. It's a private placement. We've done a couple of other things, but we haven't done any of those recently. And, we just thought it was really important, especially for the downtown investments. Those are the things that are really capital intensive. We thought it was important for us to have a long-term vision. It's hard to do that when you raise money through a syndication. And we thought it was important for us to put our own money into it. And so those investments are our capital. Some of that is our private lending capital or our flex capital that we have from some of the private lenders that are on the call right now. But that capital does not have short timelines to return. Those are timelines of 3 years. And many times our investors just continue to roll that money over. So, short answer to your question, we have considered it. We have done it. We did it earlier on in our investing journey. Many of those opportunities were, 6-10 years ago. And, we're at a place now where we have access to capital on the debt side that we really don't have to give away the equity, which is what you do with a syndication as well for most of those. So it's a better thing for us and a better thing for the community, so that the money that we put into it does not have short-term expectations. And so that's why we don't really offer those types of syndications.
Okay, there you go, man. Good answer. Eddie Harris from Hotlanta checking in has a question. Has Wall Street had any effect on JWB's efforts to buy more homes in Jacksonville?
Has Wall Street had any effect? Sure. I think the effect of Wall Street in Jacksonville and in other markets gets overblown. And it's because the way that the media reports it is a little bit misleading. I think we've all read articles. We talked about it a little bit on the show where, 30% of purchases were by investors in Jacksonville and other markets, especially over the last year, as people have been rushing into this space. That may be an investor, but many of those investors are you and me. And the way that they define that is by the entity. So if you buy in a company name, you would register under that 30% figure. If you actually look at the number of homes that are owned across the country that are owned by big Wall Street firms, John Burns did a study on this, and I think it's like 1% or 2% of all homes that are owned. So I think the effect gets overblown. We do have Wall Street buying in Jacksonville like they're buying across the country, which is great, but it hasn't caused us to significantly change our plans. It's not something that we talk about when we're sitting down and saying, how many properties are we going to acquire this year? Do we need to bob and weave because Wall Street is here and buying? No, that didn't come up at all in our business plan. So they're here. It's another investor, but it is not an outsized impact on this market.
Cool. There was that asked in the Q&A, how to find past episodes of the show, because Facebook is hard to do. Just so you all know, we repurpose this stuff into podcasts and we repurpose it into YouTube. So if you like listen to podcasts or you like watching YouTube, if you put Not Your Average Investor Show in any of those, you're going to find all the episodes of the show. We got 200 plus episodes. I've been doing this since early 2020. So you can find the whole catalog on your platform du jour. All right. We got a Not Your Average guest. That's actually Mitch is his name because he put his number here in the chat in the Q&A. Different kind of questions you see, but maybe you can point them the right way. I may have missed it, but can you show where those 20 blocks of downtown purchased by JWB are? Also, do you have any for sale or can denote to build upon for a good cause, such as veteran housing and or affordable housing? Or maybe you guys can point me in the right direction if you don't have any lots for donation or deep discounted pricing. I think he's just looking for some direction on like where to find that, something like that.
Yeah. Well, Mitch, it's great to have you here on the show. Thanks for being here. And thanks for, contributing with a great question here. The blocks that we have purchased largely are on the north bank of Jacksonville's downtown in the north core. We're kind of relabeling that part of town along with our friends who are investing there, other developers that we know very well. I think you're going to be hearing a lot about the north core, which is kind of like a little bit north of City Hall, a little bit to the west of City Hall, north and west. We're going to be walking through that on the downtown tour this Saturday. Do we have any homes for sale or can denote any for veteran housing or affordable housing? Here's one of the really cool things. It is really hard to have new construction homes built that are affordable, right? It's hard as home values have gone up so much. Typical builders now have to, pay a lot more to acquire the land. They have to pay more to build the infrastructure and they have to pay more to actually build the house. So it's hard for them to have new construction homes that are affordable. JWB homes are affordable, right? They are affordable. And we do that because we buy infill lots. We save money on the lot purchase. We save money on the infrastructure cost, and we're able to build new construction homes that are affordable. It's just really hard to do that any other way. Now, we don't sell those homes to owner occupants, so I can't solve that problem for you. But renting a home in one of our neighborhoods is a brand new construction home, might be an opportunity for you. Or if you just want to reach out to my team, I'm sure we can point you in a direction of other organizations that do help with affordable housing. Every year we build a brand new construction home and we donate a home, but we do that through our partnership with Canines for Warriors. And so I'm not sure if that would apply to you. But, if you want to send an email to info@JWB companies, I'm sure we can point you in the right direction, but at least hopefully this gives you some kind of thoughts on how to find affordable housing.
Yeah, there you go, Mitch. And Shannon Baker, Touchdown Maker, is saying there's also a VA hospital going up in Ocean Way, furthest northern part of Jax. So maybe there's some stuff there, Mitch. Hope that helps, man. info@jwbcompanies.com. Tell them that you're the guy from the show. They'll point you in the right direction, man. And then finally, Leslie Wilson has a great question here. Is there any talk of displacement of existing communities because of the rapid appreciation? It's a big issue here in Denver.
There is talk about that, but I think it's about how do we get out in front of this? We haven't seen this rapid revitalization of downtown yet, but because we have seen these issues with displacing communities in other successful downtowns, we know that it's coming. And we're working with the existing communities to do this the right way. We really believe there's a way to make sure that everybody wins here as downtown revitalizes. It's called withintrification. It's not gentrification, it's withintrification. It's a term that we use and that others have used before us that involves sitting down with the leaders in those communities and saying, okay, well, this is the way that we see things happening. How can we make this a win for you? What does that mean for you? It might be, putting some rules or some codes in place to make sure that as new homes come up, that they retain some of the features that are important for that neighborhood. Those are some of the things that we've been a part of as we've built in some of these neighborhoods and have worked with those relationships. So there is talk now. The really good thing is that we can get out in front of it. It's something that we can do where everybody can win. In other places, many times it's viewed as something that is completely negative, and where one community feels like they lost, where another one really gains. And so we're hoping that it's not that way in Jacksonville.
There you go, GC. Good answers, man. Good show today, right? Like I think you can go back to the annals of the Not Your Average Investor show. You see the first time we did this, we just kind of went fake turnkey, real turnkey, vertical integration. And I think it'd be really interesting for fans of the show, if you want to go back and see like how much the message has evolved, right? Like how much data you've been able to pull that makes this a completely different conversation now, how much you're doing in downtown that's become true from 2 years ago that really changes the game of what you're doing. I think it's a really, really interesting thing to revisit if anybody wants to go back to it. I think I'm going to go check that out. I'm not sure exactly what number it is, but if you go, probably in the first 50 episodes that we did, it's somewhere in there, right? But more than anything, We had 50 plus people here with us for an hour. It's a Tuesday, middle of the workday. The idea that we get this community that comes here to be part of this conversation, I never take that for granted. So I really want to thank the community for popping out here. Super pumped to hang out with the community Thursday, Friday, Saturday. We got a dinner on Thursday. If you haven't been reached out to by Jen, check in with her. We're going to dinner at Jay Alexander's in Town Center. Saturday is going to be the tour and all the good stuff. We got karaoke later that day. Definitely delivering on the karaoke. So I'm super pumped to see the community in full effect, man. I just want to thank everybody and give you last words, man.
Yeah, man, it's so fun. I still am slightly shocked every time that you all show up in such high numbers, just sit here and talk about what I love to talk about, which is, this asset, it's investing overall. And I think the reason is because we have kind of carved out our own little bubble of the internet, our own little niche where, we can be like-minded, be positive, and we have such a strong community. So thank you guys for making this such a wonderful experience each and every Tuesday and Thursday. And I'm so fired up to hang out with you guys this weekend. Thank you to the 40 plus folks that are signed up and are ready to join for the tour. It's going to be an awesome experience. Can't wait to see you all in person and hang out with all of our buddies.
All right. See you Thursday for a POTW. And if you learned anything today, it's that if you want to get a great experience and higher returns than normal in a passive investment, you got to look for vertical integration, and you can't be average. See y'all on Thursday.